Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over bar area 3. This is section C4. This is an application topic. Calculate the total indebtedness, try to say that 5 times fast, indebtedness, to be reported in the government-wide financial statements of a state or local government. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, for free, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to want to learn more, so make sure you also check out becoming a pro member where you get access to the pro course, or purchasing our study materials like our mini quizzes, audio notes, and review notes, or of course getting the total bundle where you get access to everything. And something that is currently a part of the pro member package but is going to eventually switch to being a part of the study materials is the full versions of these multiple choice question walkthrough videos. So in today's YouTube video, we're only going over 5 questions, but in the full version, there are 10 questions so that people who have the pro course currently, but it's eventually going to switch to the study materials, people who have the study materials will have access to the full 10 question version to get a little bit more help and a little bit more understanding. So if you like these videos, make sure you check out becoming a part of SuperfastCPA. The best way is to, again, check out that webinar and then get the total bundle so that you have access to everything. Now, with all that said, let's dive straight into the questions for this video. All right, here we are at question 1, and finally, after multiple videos where it was smaller topics that only warranted about 5 questions, this time it is something that's bigger, so we're going over 5 questions on YouTube, but 10 questions for SuperfastCPA members. And this one is much more in-depth, or at least much more interesting, in my opinion, than the previous videos. So we're going to learn how to calculate total indebtedness. So let's dive into that. So the first thing that I always want to point out is you want to read the last sentence of the question first, especially if you see a question like this where it has a whole bunch of information and you're going to need to read through it. It's best to read the last sentence first to give yourself context for what you're even going to be doing, so that when you read through the rest of it, you know what you're trying to figure out. So let's do that here. What is the total indebtedness that should be reported for the governmental activities of the city in its government-wide financial statements? Okay, let's go up to the top. A city has the following outstanding obligations: general obligation bonds, $4,860,000, compensated absences liability, $315,000, claims and judgments liability, $228,000, lease liability, $472,000, tax anticipation notes, $640,000, accrued expenditures for goods and services received before year end, $186,000, and then finally, probable additional claims and judgments expected to be paid in 6 months into the next fiscal year for $94,000. So we have a lot of information there. What is going to go into total indebtedness? And sorry, that is a word that I struggle a little bit to say, so forgive me if I sound a little silly saying it throughout this video. But again, how are we going to calculate that? If you have any idea, or if you want to give it a guess, go ahead and give it a try. Maybe pause the video, and when you're ready, come back. We'll look at the answer together and start learning how to calculate this. All right, here we are. The answer is C, $6,795,000. So let's go through this to start learning how to calculate total indebtedness. All of the listed amounts are included, resulting in total indebtedness of $6,795,000. So we don't go through the calculation here because all you have to do is add up all those numbers, and they all add up together to be that total, and we're including all of them. So let's go through this to start understanding what we're even supposed to put into total indebtedness when it comes to government-wide financial statements. General obligation bonds are debt because they represent borrowed amounts that the city is required to pay. So general obligation bonds is going to be counted in this total. Tax anticipation notes are also borrowings, even though they are generally short-term and are expected to be repaid using future tax collections. So again, another thing that is going to be included. And just to kind of point it out, anything that says a liability, that's probably debt. So compensated absences liability, that's debt. Claims and judgments liability, that's debt. Lease liability, that's a debt. So we're kind of going over here in the explanation the things that might not have been so obvious. Accrued expenditures are included because the city has already received the related goods or services and therefore owes payment. The probable additional claims and judgments are included because the loss is probable and can be reasonably estimated even though payment is not expected until the next fiscal year. So it is a liability because it's probable and they're expecting to have to pay it in the near future, so they're counting it as a liability. Total indebtedness is not limited to traditional long-term borrowing. It includes the government's outstanding obligations that require future payment, whether those obligations arise from borrowing, unpaid goods and services, employee benefits, leases, or probable legal claims. So again, in this question, we're learning a lot of the basics about what goes into total indebtedness. General obligation bonds, or just, bonds in general, usually is going to be part of it. Anything that's a liability, tax anticipation notes, accrued expenditures, and even probable additional claims for the liabilities that we already have, those are all things that are most likely going to be included in total indebtedness. So we learned a lot in just that one question. Now let's go to the next question to learn a little bit more. All right, here we are at question 2. Again, reading the last sentence first. What amount should the city report as total indebtedness in its government-wide financial statements? And by the way, that's pretty much going to be the same question that we're asking throughout this entire video. It might not even be worth me reading it every time, but I probably will. But again, that's pretty much the whole thing that we're figuring out throughout this video is how to calculate total indebtedness in different situations. Okay, let's go up to the top. A city has $3,240,000 of outstanding revenue bonds issued by its water utility, $165,000 of current liabilities, and $250,000 of non-current liabilities reported by its enterprise funds, a net OPEB liability of $685,000, and $560,000 of other general long-term debt. During the year, the city also reported $1,180,000 of expenditures related to governmental programs. Okay, so out of all these numbers, based on what we learned in the previous question, you might have an idea of what's going to be included, but there's a few things in here that we haven't talked about yet. If you want, go ahead and give this a try, pause the video, add up what you think would be included in the total indebtedness, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is B, $4,900,000. Let's go through this. The city should include the revenue bonds, current and non-current enterprise fund liabilities, OPEB liability, and other general long-term debt. Together, all of those add up to $4,900,000. Total indebtedness includes both current and non-current liabilities. So don't get confused by this is due in 6 months, this is due in 5 years. Any liability that would be included in total indebtedness is included whether it's current or non-current. We're going to learn a little bit about what kinds of things are not going to be included, but so far, if it would be included in total indebtedness, it doesn't matter if it's current or non-current. A liability is not merely excluded because it is expected to be paid soon, and it is not limited to traditional long-term borrowing, like we already mentioned. Revenue bonds are included because they are borrowed amounts the city must repay, even though repayment is expected to come from water utility revenues. The enterprise fund liabilities are also included because business-type activities are reported in the government-wide financial statements. The $1,180,000 of expenditures is not included merely because it was reported as an expenditure. An expenditure reflects the use of financial resources and is not necessarily an unpaid obligation or outstanding debt. So one thing I want to make very clear there, just in case it's not clear yet as you've been working through the governmental section of BAR, expenditures don't decrease a liability. Expenditures are essentially just expenses. That's just the government's version of expenses. Or, that's an easy way of putting it. So expenditures are just the government using its money. So if the government has a liability because they got $20 million from bonds, and then they're using some of that money for something, they're using it as an expenditure, but that's not decreasing the liability because they still have to pay the liability as a separate thing. So when you see expenditures, don't get confused and think, is that going to be part of total indebtedness? Probably not. So don't get confused by that. We learned a little bit more about what's included, and something very important you need to remember here is that business type activities, like debt associated with those, so, the proprietary fund or the enterprise fund, those are going to be included in total indebtedness. So we learned a little bit more there. Now let's go to the next question. All right, here we are at question 3. What amount should the county report as total indebtedness in its government-wide financial statements? Again, same question pretty much the whole time. Let's go up to the top. At year end, a county reports $3,780,000 of outstanding general obligation bonds, $2,140,000 of revenue bonds issued by an enterprise fund, a compensated absences liability of $286,000, accrued expenditures of $174,000, and a net OPEB liability of $520,000. The county also reports $910,000 of liabilities in its fiduciary funds and $265,000 interfund payable owed by the general fund to a special revenue fund. So, based on everything we've learned so far, you probably already have a good idea of, for most of these things, if they're going to be included in total indebtedness or not. The question is, are fiduciary funds, are interfunds included as well? So think about that. Pause the video if you need to, do the calculation as best you can, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is D, $6,900,000. So this is just teaching us another rule about what's included. The county includes the general obligation bonds, revenue bonds, compensated absences liability, accrued expenditures, and OPEB liability. Those are all things that are going to be included, and so that means that you add those all up together to get $6,900,000. However, this is the key to this question. The fiduciary fund liabilities are not included because fiduciary activities are excluded from the government-wide financial statements. The government holds or manages those resources for parties outside the government rather than for its own programs. So again, fiduciary funds are not included in the government-wide financial statements because even though the government has that money, they're really just holding that money or being in charge of it for somebody else, for another organization or whatever the case is. So it's not really the same as just money for the government. The interfund payable is also excluded because it represents an amount owed by one county fund to another county fund. Interfund balances between governmental funds are eliminated when the funds are combined into the governmental activities column of the government-wide financial statements. So we learned a very important rule there. So far, we've learned a lot of the things that are included in total indebtedness, but don't let yourself get confused. Anything that has to do with a fiduciary fund, which would be like a pension trust fund or a custodial fund or things like that, anything that's fiduciary and anything that is interfund payable is not going to be included in total indebtedness. So don't get confused by those things. They're not going to be included. So we learned again another rule there. Now let's go to the next question. All right, here we are at question 4. Again, we're figuring out what the total is. A county's governmental funds report $14 million of proceeds from bonds issued during the current year and $12 million of capital outlay expenditures. At the end of the year, the county's government-wide financial statements reported net capital assets of $11 million and net investment in capital assets of $6 million. All debt still outstanding at year-end was related to the acquisition or improvement of capital assets. So this is a totally new kind of question. We're still calculating total indebtedness, but we're given totally different things here. We're given, some information about bond proceeds and capital outlay expenditures, which we've kind of seen some stuff about expenditures and bonds, but we have never had to deal with, in the previous questions, net capital assets or net investment in capital assets. So how the heck are we supposed to use this to calculate total indebtedness? So that's the point of this question, is to learn how to do that. Now, if you have any idea how to do this, go ahead and pause the video, give it a try, or if you just want to give it a try anyway. But if not, let's go ahead and go to the answer to start learning how to calculate it in this situation. All right, here we are. The answer is A, $5 million. So this is actually pretty straightforward, but if you've never seen it before, then you might not really know what to do. So let's go through this. The year-end capital asset balances are used to calculate the debt that remains outstanding. So the way you can figure this out is typically net investment in capital assets equals net capital assets less the capital-related debt. And the equation is a little bit larger than that, but that's the basic idea that you need to know for this type of question. So again, that's the equation. We were given net investment in capital assets, and that was $6 million. And we were given net capital assets, and that was $11 million. And you can probably see that fairly easily we can kind of move the equation around and figure out what total indebtedness or the capital-related debt is. So the capital-related debt is $5 million because 11 million less 5 million equals $6 million. And again, you can kind of just move the equation around a little bit to figure that out. Because all of the county's outstanding debt is capital-related, total indebtedness is $5 million. So this isn't always going to be the case, but you might see a question similar to this where total indebtedness is equal to the total debt that was outstanding for capital-related things because it says that. At the end of the year, all debt outstanding is related to the acquisition or improvement of capital assets. So since we know that all debt is related to that, that's why we can do this kind of a calculation and see that the capital-related debt is $5 million. Therefore, the total indebtedness is $5 million because that's the only debt that they have. The bond proceeds and capital outlay expenditures represent activity during the year rather than the ending balances. The amount of bonds issued does not necessarily equal the amount still owed at year end, because some principal may have been repaid or retired. Therefore, the year-end net capital assets and net investment in capital assets provide the relevant information for determining outstanding debt. Now, something that I don't want you to get confused on. In the previous questions, we were just adding up a whole bunch of debt and it had nothing to do with timing. And you might see questions like that where you're just adding it all up and it doesn't really matter, like, did they pay some of this throughout the year? You're just given the information and you're supposed to add it up. But in this situation, it's kind of giving you a red herring or a distraction, because it's saying this is how much money they got from the bond proceeds. So that would be a $14 million liability. And they also spent $12 million in expenditures. So is that going to affect the capital assets or anything like that? But then it says at the end of the year, here are the totals. So this is stuff that just happened throughout the year, but we don't really know all the things that happened. All we know, or all that we are given, is the end totals. So when it comes to this kind of a question, because it's asking for it at year end, that's where we are going to use the year end totals instead of paying attention to these, the bond proceeds and things like that. So make sure you pay attention to what it's asking. Is it asking for the year end totals, or is it just asking to calculate total indebtedness? So just want to make sure you pay attention to that. Now let's go to the next question. All right, here we are at question 5. Let's go through this. What amount should the city report as total indebtedness? Let's go up to the top. A city's governmental funds reported $9 million of capital outlay expenditures during the year. All of the expenditures were used to acquire capital assets at year end, so no depreciation had yet been recorded. The city's business type activities reported capital assets with a book value of $5 million. The city's total net investment in capital assets was $8 million at year end. All outstanding debt was related to the acquisition or improvement of capital assets, and there were no related deferred outflows or deferred inflows. So again, we're trying to calculate total indebtedness. Based on everything you've learned so far, you probably can give this a good try. So I want you to pause the video, do this on your own, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is B, $6 million. So let's go through this. Again, we kind of learned how to do most of this in the previous question and then the other questions throughout the video. The governmental capital outlay expenditures resulted in $9 million of capital assets. So remember, expenditures don't necessarily equal the liabilities or anything like that. But because the assets were acquired at year end, no depreciation has yet reduced their reported book value. So we know that the company spent $9 million to get capital assets. No depreciation has taken place. So we can actually use those capital outlay expenditures to figure out that, hey, they have $9 million of capital assets from that. Then we go to the city also reports $5 million of capital assets from its business type activities. Therefore, total capital assets reported in the government-wide financial statements is both those together. So 9 million plus 5 million equals $14 million. And you might see a question like this where you have to figure out the assets, like the total assets or total capital assets, before you can go and then figure out the total indebtedness. So we now know that the total capital assets is $14 million. Net investment in capital assets is equal to capital assets reduced by the outstanding capital related debt. So 8 million equals 14 million less the total indebtedness. And again, you can kind of just move that around and figure out that 14 million less 6 million equals $8 million. So therefore the total indebtedness is $6 million. So again, just kind of showing you another version of that kind of question that you might see when it comes to calculating total indebtedness in a situation where you're given the net capital assets or net investment in capital assets and then capital assets and things like that. So we've learned a lot in these 5 questions. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, as a reminder, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you how to calculate total indebtedness when there is net investment in capital assets, or, a different kind of question trying to teach you something else. Whatever the case is, you notice these things throughout the questions, and so you take a moment and write out the key thing, the pillar topic that you learned from those questions that was kind of the common theme between them, so that you know one of the key points that you need to know for exam day. So with that, let's go ahead and take a look at the pillar topics. All right, here we are at the pillar topics. Again, essentially just kind of a summary, kind of the key points that we pulled out from the questions, the things that we were supposed to learn from the questions. So let's go through this. First, total indebtedness includes both current and non-current liabilities that require future payment, not just traditional long-term bonds. Again, one of the key things there is current and non-current liabilities. Whether it's current or non-current, if it would be included in the total indebtedness, then it's included. This may include general obligation and revenue bonds, compensated absences, claims and judgments, lease liabilities, tax anticipation notes, accrued expenditures, OPEB liabilities, enterprise fund liabilities, and other general long-term debt. Next, this is important too. Fiduciary fund liabilities are excluded because fiduciary activities are not reported in the government-wide financial statements. Interfund payables are also excluded because amounts owed between funds are eliminated when the funds are combined. Next, an expenditure is not automatically included in total indebtedness because it represents the use of financial resources, not necessarily an unpaid obligation. It's essentially just them spending money. It doesn't necessarily affect the liability itself. Bond proceeds and capital outlay expenditures reported during the year also do not necessarily equal the debt or capital assets remaining at year end. And again, that was something that you need to pay attention to. If the question is talking about year end, then don't get caught up in thinking that all bond proceeds or all capital outlay expenditures or whatever are going to affect it necessarily. Now, again, a lot of the questions you might see, they won't mention year end, so you might be able to assume that bond proceeds were part of the debt. But if it mentions year end, you might have to look a little bit deeper. Finally, when all outstanding debt is capital related, total indebtedness can be calculated by subtracting net investment in capital assets from net capital assets. Be sure to first combine the capital assets of governmental and business type activities and use the relevant year-end balances. Again, just kind of one of the key points there, you're including general or governmental debt and you're including business type debt, and then of course not fiduciary debt. Now, we learned a lot in these 5 questions and in these pillar topics, and that is the end of the YouTube version of this video. Again, we're only going over 5 questions today, but if you become a part of SuperfastCPA, you can get access to the full version of this video, which has 10 questions, so that you can get a little bit more help and a little bit more understanding. So again, if you like this, make sure you check that out. One of the best ways to start learning about SuperfastCPA is by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And then, of course, that's the best path to learning about the rest of SuperfastCPA, which is, maybe becoming a pro member or maybe buying the study materials, or best thing would be to get the total bundle where you get all of our products. So make sure you check all of that out. Now, if you found this video helpful, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.